If you search for trading online, you see the same thing. Young traders showing luxury cars, massive profit screenshots, and claims of making lakhs of rupees from a laptop. They make it look like all you need is a few indicators and some chart patterns to become rich. But that's an illusion. Looking at charts alone isn't enough to survive the financial markets. After 2 years of studying price action, market psychology, economic events, and maintaining a trading journal, I learned something important. Market data by itself does not guarantee success. In this video, I'll share the exact mistakes that cause most traders to fail, so you can avoid them before they cost you real money. The first major mistake that chart study alone cannot fix is a psychological trap called catching a falling knife. Imagine a stock falls from 1000 rupee to 600 rupees. You look at the chart and think, it was 1000 rupees before. Now it's only 600 rupees. This must be a bargain. But cheap can always become cheaper. A stock that falls from 1000 rupee to 600 rupee can easily drop to 300 rupees. Many traders lose money because they buy solely based on a lower price rather than actual evidence that the trend has reversed. When you buy a falling asset just because it looks cheap, you're not following a strategy. You're gambling on hope. Professional traders wait for confirmation that buyers are returning before risking their capital. Patience is often more profitable than being early. The second mistake that destroys consistency is revenge trading. Imagine you enter a trade according to your rules. The market moves against you. You take a loss. Immediately, frustration kicks in. Your brain stops thinking logically and starts demanding one thing: get the money back. So you enter another trade, then another, and another. Soon, you've taken multiple random trades in a single session without any proper setup. At that point, you're no longer trading a system. You're reacting emotionally. Many trading accounts are destroyed not because the strategy is bad, but because the trader loses emotional control. Sometimes, the most profitable decision is to close the charts, step away, and come back with a clear mind. With all these mistakes, how does a trading account survive? The answer is simple: risk management. Most beginners risk far too much on a single trade. Some put 20%, 50%, or even their entire capital into one idea. The problem is simple. If you're wrong once, your account takes massive damage. Professional traders focus on capital preservation. A common rule is to risk only 1% to 2% of your total account on any single trade. For example, if your trading capital is 1 lakh rupees, risking 2% means your maximum loss on one trade is 2000 rupees. Even after several losing trades, you still have enough capital left to continue learning and improving. This mathematical buffer keeps you in the game long enough to develop real skill. Without risk management, even the best chart patterns become useless. Mastering the financial markets is difficult. There are no shortcuts. There is no secret indicator. And there is no guaranteed strategy. Consistency comes from having a clear system, documenting your trades, reviewing your mistakes, and continuously improving. The people who succeed are not always the smartest. They're the ones who stay disciplined long enough to learn from experience. If you're interested in a realistic journey of learning trading, investing, and personal finance from the ground up, follow along and let's improve together, one lesson at a time. See you in the next video.